We're starting with the second set of notes, support material 2. As I said a bit earlier, this is a short section. It's looking at budgeting. Right? Budgeting will always come up. You often see questions, either maybe a longer question in terms of drawing up a table, different months, and then projecting sales and cost of sales. Okay, so just to recap one or two things, last week we introduced the module and we focused on this, okay, the financial planning process. Okay, now we're moving more towards the other. Okay, so each and every one of these, let's say, categories are covering a different chapter in your textbook, or not your textbook, your study guide, your textbook. There's only 3 chapters that you actually need to look at, okay, in the textbook. All right, so today we're going to be focusing on the actual cash flow, right, in terms of the analysis and how we budget for certain income and expenses. Okay, so we spoke about different decisions that financial managers need to do. Okay, so definitely day-to-day is key. Right, so what did we say represents the day-to-day running of the business? What measure are we going to be looking at that tells us how much the day-to-day cash flow is in terms of the business? Think about your cash flow statement.
So what measure?
Yeah, what measure would we look at? We would look at the income or the cash flow from the operating section of the statement of cash flows. Okay, so operations would be what we'd be looking at there. Okay, planning could be maybe the financing or the investing. Yes, good. Okay, so financing or investing would relate to planning. Okay, so you generally plan. So the point I'm trying to make here is operations is day-to-day. That's income and expenses in terms of running the business. Okay, the financing is what? No, that's the investing. Okay, the investing would be the assets. Okay, so if I invest in equipment, machinery, etc., that'll be part of your investing activities. Your financing is your debt or equity. Okay, so debt or equity. So we know companies can either use debt or equity to finance a business. Right, are those considerations going to affect the day-to-day running of the business? Yes, it would. Okay, how would investments in assets affect day-to-day running of the business?
Productivity, I suppose.
Good. And what else? Let's talk about the monetary side of things.
So how would it
yeah.
So you're obviously increasing your balance sheet, I guess, and more value to the firm. I don't know.
Yes, and what influence would that have on the operations in terms of monetary benefit?
So increasing cash flow.
How would it increase cash flow?
So
you're right.
Yeah, you can put more. If you've got a good machine, you can push more units and get more cash flow.
Okay, what about the tax implication?
Yeah.
What tax implication is there for assets that are purchased?
So you get capital allowance.
Correct. Okay, you get those allowances in terms of SARS that you would be able to deduct. So there would be a saving that you would be able to receive on any purchase of a new asset. Okay, and that's why. Yeah, but that's operations. That's fine. That's one motivation, right? But if we're focusing more on the finance side of things, the biggest reason that we would have to buy or expand our asset base is the tax benefit that you get. Okay, and that's why SARS has something called a capital allowance, right? Because items of a capital nature cannot be deducted. Okay, they're taxed differently in terms of CGT. But because we have a tax on capital assets in terms of, or let's say an allowance on capital assets, that gives us the opportunity to write off assets that I've bought that are going to be used in the business for a long period of time. And obviously different types of businesses would be able to write off different assets over a longer or shorter period of time. Okay, and then the financing is the debt and equity, so interest, that's key. Okay, interest is tax deductible. So debt would be preferred, okay, in terms of being the first choice. Equity would be the second choice because you don't get as much benefit issuing shares as you would, let's say, taking out a loan, okay, or issuing a bond. Right, and then obviously, yeah?
Sorry, just a quick question. So I'm talking about investing. What happens if you see a cash flow where financing is a net inflow and investing is a net outflow?
Okay, so if financing is a net inflow, then you would have
Taken debt.
You would have, yes, either increased your debt, there would have been an inflow in terms of cash, or you would have perhaps sold more shares.
Okay, so if financing was an outflow,
financing was an outflow, then it would be the opposite.
So you receive
So you would have paid off debt. Correct.
Settled your debt, and now you invested in assets. It wouldn't make sense. You would say something would be wrong. If you investing, so investing is
Okay, so if the one is affected, will the other one automatically be affected? No, because we're looking at cash flow. Okay, so you're looking at things from an accounting point of view. Because the accounting point of view, you can only have one cash transaction, i.e., one part of the transaction will be cash and the other part will be an accrual. Okay, the asset or whatever. Okay, so you can't have financing and investing being affected from a cash flow point of view, because we know from last week cash can only be used in 3 areas: operating, financing, investing.
So you can't say, well.
So you can't have a cash flow effect.
Efficient by having receiving cash or financing with investing in assets.
Yeah, you could have that.
You could have that.
But the thing is, it's still cash though. So what is the cash being utilized for? So financing is still financing. It's separate. Whether it's an increase or decrease, that's irrelevant. Okay, that's looking at that side of the business. Then the investing is, well, what are you doing with cash? Are you investing it, yes or no? Okay. Right, then we obviously know decision making is key, and then today that's the focus. Alright, so budgeting is one of the responsibilities for a financial manager. Okay, morning. Here's your file with the rest of the notes. You've got last week's. Okay, so just add those to these and then you've got everything. Okay. Alright, so depreciation is something we spoke about. That's the motivation for doing what? Purchasing assets. Okay, would depreciation be part of the budget? Yes, because that'll be seen as an expense. But is depreciation cash flow? No. Okay, we need to take it out. Right, cash flows, we know we get operating, investing, financing. We just recapped that. And in terms of your OCF and FCF, okay, here we're looking at the depreciation, right? And the FCF is looking at the free cash flow to the firm. Okay, so obviously the firm is debt and equity. Alright, so free cash flow is what available funds do you have that can be attributable to the creditors and to the equity holders. Okay, people holding equity. Okay. Alright, so today's focus, okay, well the first part is looking at a budget. Alright, so 2 is the financial planning process. Okay, so how do we actually get to one of these, let's say, plans? Okay, remember everything needs to be planned, i.e. you need to have some sort of guideline, right, to guide the business towards the goal of maximizing shareholder wealth. Okay, the focus is always on wealth rather than profit. Okay, profit's a byproduct of generating enough value. Okay, so the learning outcomes here, you do need to be familiar with the process. Okay, that could be a theory question that could come up. The main, let's say, focus in terms of tests and exams would be the actual budget. Right, would you be able to forecast, okay, and generate a table of values that would represent what we would expect would happen in the future? Okay, so are we going to be receiving more or less? Okay, what would be the outflow or inflow? Okay, what's the net effect? Okay, those would be things that you would have to consider. Alright, so to start off, you get 2 types of planning, long-term and short-term. Okay, obviously long-term is more focused on strategy and the goal. Okay, so what are you trying to achieve? That's the long-term goal. Right, normally long-term would be greater than 5 years. Okay, 5 years or longer would be considered, let's say, more focused on strategy, more focused on that underlying goal or purpose. Why are we doing certain things? Okay, the short-term is looking at the month-to-month, the week-to-week, okay, the day-to-day. Right, so that's looking more at the operations. Okay, so you've got 2 key considerations, long-term and short-term. For a business to be successful, they obviously need to focus on both. Do you agree? Okay, but what guides the long-term goal? How do you achieve that? It's the day-to-day operations. Okay, so are we managing our current assets and our current liabilities? Okay, if your goal is to generate wealth for shareholders, can you achieve that if your current assets and current liabilities aren't being managed or controlled effectively? No. Okay, you're not going to be able to achieve a long-term goal if you can't even buy, okay, and pay for certain current assets. Okay, so if the focus is inventory, let's talk about a trading entity, okay, buying and selling goods, okay. If you're buying and selling inventory, that's a whole department on its own that needs to be responsible for requesting the stock, purchasing the stock, managing the stock, receiving the stock, checking the stock, and doing all of those, let's say, behind the scenes type of support. Okay, so inventory would be something that would be a current asset. Okay, the business is obviously focusing on sales. Sales is the most important line item on any income statement, okay, or statement of comprehensive income. Okay, so that's the key. Right, obviously sales are generated because you've got inventory to sell. If there's no inventory to sell, you're not going to be able to generate or increase this. Okay, so a business needs to obviously look at operations and make operations as, let's say, effective as possible to drive performance to make sure that those long-term goals are achieved. Okay, so what must we do? We need to budget. Right, everything needs to follow a budget. Okay, so when budgeting, I need to look at projected, okay, income and expenses. Right, and then I need to obviously compare that to what I actually have. Okay, once I've lived through that time period. Okay, so what is a budget? Correct. And what does the plan show you, or what does the plan entail? It's a breakdown of what? Correct. Okay. Is it only income and expenses? Well, you could also forecast, okay, effects against other statements. Okay, so it's just a breakdown of, you could say income and expenses, okay, and you could also talk about maybe inflows and outflows, okay, because the budget is not going to be looking at accruals, right? The key word here is cash. Okay, so are we concerned with debtors and creditors? Yes, only in terms of receipts and payments. Yeah, from a cash point of view, right? But debtors and creditors wouldn't be the focus in a cash budget. The focus would be, is it an inflow or is it an outflow? Okay, and why is that relevant? Well, it's long-term and short-term, right? A business needs to meet their short-term need for cash versus their long-term goal in terms of maximizing shareholder value. Okay, so obviously we need to try and manage this a bit better, because as long as we stay in business, okay, we're obviously going to generate future benefit for shareholders. Right, so do you guys budget? Yes? Yes? No? Okay, so why do the two of you budget?
You study all of this and you don't budget.
I budget for the company, but not for me.
Okay, so why do you budget? So Indira and Lee budget. Why?
I'm just OCD.
Okay, so
You know what's happening.
all right, that's a very good point. That's what? Information, it's data, right? So if you don't budget, you're not going to have an idea of where are you spending the majority of your income, okay, or where are you deriving the majority of your income. Okay, all right, and what other reason would we have for budgeting besides keeping track and getting information? Correct, yeah. So if something's not working currently, the only way you'll actually realize that is by getting the information. Okay, once you've got the information, now you've got it. Okay, so let's say you're buying. Okay, so I think Tanya's the only smoker in the class. Am I right or not? Okay, so are you, or does Indira also smoke? Lee? No. Okay, so okay, I hope you don't mind, but I'm going to talk about smoking. Let's say we've got a smoker, right? Would a smoker realize how much money they're actually spending on cigarettes daily, perhaps, maybe monthly, maybe even yearly? So how much do you actually spend on smoking?
Well, mine is very easy to work out.
Okay, yeah, you'd probably work it out now. You're thinking about it, but
no, generally, if I'm not going to say I'm thinking, I don't.
Yeah.
If I had to budget, I would have 2,000 cigarettes. No.
yeah, you probably wouldn't budget for it because it's something that you've become accustomed to.
No, exactly. You don't really want to know.
But shouldn't you know?
Sure. I ran an app once and it's scary. So.
Okay. All right. So yeah. So budgeting, besides providing the information, it also helps you to plan. And maybe smoking is affecting your budget. Maybe it is a large portion of the budget. So maybe you could cut down on smoking, perhaps, or even consider quitting, depending on the situation. Okay. So why do companies budget? So that's more the personal. If we're looking at companies, key reason why companies budget. Why do they do it?
Well, to make profit.
Okay, so companies are obviously looking at targets. All right, so how do the sales staff get their targets? So why, if I'm a sales person, okay, how do I know what target do I need to achieve? It's because of the budget. Okay, that's the forecast. All right, so obviously the sales team is going to be given certain targets in line with what was budgeted for. Okay, because remember, the budget is not only about the expense side of things. More important is actually the income. Okay, because none of this is going to be paid if this doesn't exist. Okay, so targeting, okay, or setting targets in terms of specific amounts. So how much do we want to achieve this year to make sure we cover the budget? Okay, and you guys are familiar with something called break-even point, eh? Okay, so companies use a break-even analysis to determine the minimum requirement in terms of continuing to operate. Okay, if you can't break even, there's a problem. Okay, if you are breaking even, great. Anything after that point would be seen as profit. Okay, so companies obviously do it for profit reasons. Okay, so companies are driven by profit, right? And it's obviously targets that need to be created. And something else that's also important in terms of budget is limited resources. Okay, so companies don't have an unlimited amount of resources. Okay, and that's the main reason why they budget. They need to decide where to allocate funds, where to allocate resources. Okay, and the way they do that is budgeting. So all departments budget. They have to. Alright, so what is a budget? There's the definition. Okay, it's looking at inflows and outflows. Okay, budgeting is that, analyzing your inflows and outflows. What time frames can we consider? Well, they vary. Okay, you guys aren't going to have to draw up a big budget. Okay, it's going to be maybe maximum 3 months. Okay, January, February, March. No, I doubt they'll give you more than 3 months. It's just not necessary. Okay, 3 months is more than sufficient to test whether or not you can project certain income and expenses. Okay, are budgets accurate? No, they'll never ever be accurate because you don't know what's going to happen in the future. Right, so budgets are a guideline. Okay. Okay, but they're not exact.
No, they're not exact.
So accuracy is being exact. Okay, so that would be more forecasting in terms of an estimate or a guide. Okay, so it's a guideline. Right, so your guidelines might be pretty good. Okay, you might be within hundreds of rands in terms of what the actual expense is. Right, but it'll never ever be exact. Okay, so are budgets accurate? No. And that's why budgets can be revised. Okay, so different types of businesses revise their budgets maybe every half year, every quarter, depending on the scenario. Okay, but budgets are revised based on what? Current situation, current scenario. Okay, so we had a really good election, right? Okay, the feedback in the market seems very positive. Okay, if you guys have been following some of the news, okay? And also, what happened in terms of our rand? The rand has strengthened. Okay, so obviously we don't pay as much for pound, US dollars, and euro. Why? Because the feedback, the consensus, the information, okay, the data is positive. Okay, so if you were looking at budgeting, same thing happens there. You would revise your budget. Okay, so something else that's good is the oil price and the rand strength. So we've got a big strike in terms of the petrol sector, but price of petrol has dropped slightly. Okay, so that's something to consider. So is your budget, okay, going to be providing for higher or lower petrol costs? Okay, so if you're looking at the scarcity and having to drive around to find petrol stations with petrol, sure. Okay, but in terms of forecasting, would your budget be accurate? No, okay, because in the past you probably budgeted for rising costs of fuel. But now, fortunately, there's a slight decrease. Okay, so what does that create? That creates a variance. Okay, and you get positive and negative variances. Okay, that's a little bit of stats. Okay, just basic stats where we're looking at what we actually have compared to what we budgeted for. Okay, so forecasting is looking at everything. It's looking at the internal and external factors. Okay, you can't budget if you don't have an idea of what's going to happen externally. Right, so companies normally look at something like inflation, okay, because inflation will affect all the costs, okay, or most of the costs. Right, so that could be something that we would build into the budget. Okay, so maybe increase each cost by 6% annually. Okay, and you then create a model, right, for updating, let's say, certain line items to project what it is you'd be receiving, what it is you'd be spending. All right, so just some vocabulary. You might see this word disbursement somewhere in the textbook, okay, either in this chapter or in others, right? A disbursement just means a payment, okay, an expense, something that we need to settle, okay? A sale is an income, okay, and from a planning point of view, that's the big focus, okay? We need to check the sales and we need to know, is that in line with the budget or not? Okay, so are you, let's say, are you ahead or behind of your year to date? Okay, where should you be currently? Okay, based on the 12 months. Right, so if we're 4 months into the year, where are we sitting? Ahead or behind budget? If we're behind budget, right, the sales manager is going to have a pretty hard discussion with the sales team. Why? They're behind budget, they need to make it up. Because if the budget isn't met in terms of income, that's bad. If the expenses are greater than budget, is that good or bad? That's bad. Expenses should be below. Okay, so income should be above. Right, you want income to be higher than the budget. You want expenses to be lower than the budget. Okay, that'll be great. That'll be ideal in terms of the budgeting process. Okay, so how do we do all of this? Right, so in every question, right, UNISA will have to give you a forecast. Right, you can't make that up. Okay, so you can't make your own budget. You can't say, well, I think the sales are going to decline. I think the sales are going to increase. Okay, they need to give you that guidance. Okay, so when you look at questions, they'll talk about sales. Okay, maybe 60% received in this month, times 0. Okay, then there's a lag. In the following month, so 1 month later, I'll receive the other 30%, okay? And obviously 10% will be the remainder, and I'll receive that in the second month following the month of the sale. Okay, so the focus is always now. Okay, now what do I have and what's happening in the next month, the following month, and so on. Okay, so that's how you would budget. It's basically interpretation. Right, it's a little bit of mathematics and interpretation. Can you interpret the information given in the question? Right, there isn't a hard and fast rule that you can learn that will help you do the budget. Okay, it'll always be different. It depends on the forecast. All right, so what have they given you? Okay, obviously company and industry expectation, okay, internal external factors, those are considerations that you would have to maybe provide for in your budget. All right, so how are we going to determine what is realistic in terms of a sales figure? Okay, we need to determine that. Okay, we need to budget for that. Right, so what is the accounting treatment for sales? Simple, right? We remember a little bit of our accounts. This is what? An accrual. Okay, would a budget include the accrual? No. Okay, you're only looking at cash. Okay, and that's the focus. It's the receiving of cash. Right, so when budgeting, I'm not looking at when did I make the sale, because when would I have made the sale? The debtors would have gone up, okay, would have been debited at time 0, and it would have been the full amount. Do you agree? It would have been the full 100%. Okay, but in reality, I'm only going to be receiving cash, okay, over the next 2 months. Well, this month I receive a certain amount, 60%, then 30, then 10. Okay, so the cash flow is actually more important. Right, would the business survive, inverted commas, okay, if they only received 30% the following month? Right, how much of their creditors do they have to pay in the current month? Right, if you're going to have to pay 100% of your creditors, i.e. current liabilities, okay, in the month of the sale, would the business be capable of doing that? No, there's a shortfall, right? If you're only receiving 60% of the sales, but you're going to have to pay 100% of your creditors, there's a problem, right? Then we need to look at a solution for that problem. Okay, and that comes up later on in one of the other chapters. Managing your current liabilities. How do we do that? Okay, we need to approach banks or other providers, right, to get cash to help supplement the shortfall. Okay, so here's an example of what a budget would look like. Right, you'll have different columns for different months. Month 1, month 2, and you could have a total. Okay, obviously this could go all the way up until month 12 or even further. Okay, so what am I focusing on? It's the receipts and the payments. Okay, it's actually very, very similar to a cash flow that you've done previously. Okay, where you look at operating, financing, investing. Except here, I'm looking at categories of accounts, i.e. from an accounting point of view, but focusing on this. The cash, the movement in cash. Okay, so if I start with 100 and I end with 500, obviously end of month 1 is beginning of month 2. Okay, so that's what we would do, and we would continue that process. Okay, so if I had to put in some figures here, let's say the receipts remain the same. Okay, so we've still got 1,000. The payments also don't change. Okay, the net cash flow would still be 400. Right, plus. Okay, so we assume operations stay the same. Okay, we don't increase or decrease our operations in terms of income and expenses. Okay, everything stays constant. Is this a good business to manage? Yes, because the cash flow will always be increasing. So end of month 2 would then be the beginning of the next month, and it'll continue month by month by month. So if companies see positive cash flow, that's good. Okay, you want to see cash flow grow because cash is a way to take advantage of opportunities. Right, the more cash a business has on hand, the better. Right, you don't have to go and negotiate terms and conditions for taking out capital. Okay, no one wants to have to go negotiate a bond, okay, if they need capital. No one wants to go issue shares on the JSE if they want capital. Right, the easiest form of capital is retained earnings. Right, and how do you get retained earnings? You obviously need a surplus of profit, i.e. you need cash on hand. Okay, if you have cash on hand, that's seen as the cheapest form of financing. Okay, it still has a cost though. Okay, you've looked at that in other modules. All right, so we can forecast and analyze future expected inflows and outflows, and we know it's going to affect the decision-making process, and that's the budgeting. Okay, that's what budgeting involves. Budgeting involves forecasting and then making a decision. All right, so the last bit, okay, toward the end of this section, it's just a few general questions about budgets again. Okay, we know budgets aren't accurate. Okay, so how do we cope with this uncertainty? What can we do to provide for the inaccuracy? What do you mean put stats in it?
Statistical background use statistics where you can look at past and project forward.
Okay, possibly. So you're looking at the historical data, okay, and using maybe that as a base for forecasting. Okay, that's fine. But in terms of uncertainty, so do we know if those forecasts are going to be correct, even if they're based on the past? Is future performance dependent on past performance? No. Okay, so if we're looking at coping or providing for the uncertainty, what can we do? We can attach a probability, right? Okay, so you guys have looked at refining the model in terms of risk when we looked at cash flows. You use certainty equivalence, right? Does that ring a bell, maybe? Yes. Okay, so you could attach a probability, okay, to each of the different possible outcomes. Okay, so you could have a budget. You could have 3 budgets. Okay, a budget for normal operating conditions. You could have a budget for a recessionary type of environment, and you could have a budget for a good type of environment. Okay, a positive. Okay, so scenario analysis could also be used here in terms of providing for uncertainty. Okay, so you don't only need one budget. You can have several. Okay, you could have several budgets for the same company.
What's the point of that? Because they're not just moving the goalposts. I understand
It's for the planning. Okay, so what sort of scenario are we in? Okay.
In realistic terms, I mean, okay, I'll take our company, for example. We budget once a year. We don't do probability analysis.
And you don't do any revision of the budget?
No, there's no
Even
revision.
half yearly, quarterly, or?
No, so it's a one-off thing and no revision. And then it's cast in stone. That's it. It's done.
See, then there's no room for flexibility. There's no room for... What happens if opportunities arise during the year? Then what happens?
So then what happens is then in a monthly 6-month forecast that goes out. There's a forecast that the budget is cast in stone. And the reason being is because you don't want to move the goalpost. Once that goalpost is set, and that goalpost is set to achieve obviously a 5-year plan, you don't want to move that goalpost. So if I had 3 different budgets, I'm making the goalpost.
But then that's more the scenario analysis. So in this scenario, obviously, do you always achieve the budget?
Yes.
Okay, so the company has never ever... So maybe in that type of company, because they're so rigid in their, let's say, decision making, there's no room for revision of budgets for certain eventualities. So maybe opportunities come around. Maybe a company wants to do something. So the company wants to market or advertise or do something different. Or maybe there's a new product they want to launch. That's obviously going to affect. So for example, let's just say there's a new system that comes out and it's brand new and it changes the way we do business. Okay, so your company is not going to act and it's going to wait till the end of the year for the next budgeting period to then provide for that opportunity.
No, they're going to act. They are.
But that's not in line with the budget.
It's not on the budget, but then it's seen as an incentive.
Okay, so you've probably, see, there you go. So how did you guys cope with uncertainty? Okay, you've provided for line items, exceptional line items. So item number 1, this happens. It's an uncertainty, so you have actually built risk into your budget.
Correct. Risk is in, it's just we don't include it in the budget.
Sure, well then you wouldn't need to because you're providing for it in the current budget, yeah. So your current budget is providing for the different eventualities. Okay, yeah, okay. Alright, and then I've just put a note there, we just spoke about it, best and worst case scenarios. It's always a good idea to have an idea of what's happening in terms of different scenarios. Okay, so if I have a good scenario, okay, what will happen? Right, and you might even, that could be strategy. So if I am in a more, let's say, growth type of environment, okay, you might even say, well, there's time to do certain things. Okay, those projects that we've put on hold are projects that we might be able to implement, depending on the scenario. Okay, if it's a worst case scenario, you might be more tight with your budget, okay, in terms of what you can and can't do. Okay, right, assumptions are key. That's the important bit. Okay, so all budgets will have assumptions, right? And the assumptions will be given to you. Okay, they'll tell you what assumptions you can use. Okay, so if inflation is a consideration, they'll tell you, consider it. Okay, or they'll tell you, this is the expectation. Okay. Right, can we only budget for income and expenses? I think you know the answer. Yeah, you don't only have to budget for income and expenses. You can create something called a pro forma statement. Okay, so pro forma statements look at other. Okay, so if I plan for my income and I plan for my expenses, all that planning can then filter through to a statement of financial position, statement of comprehensive income, and you could literally create a set of financial statements that are, inverted commas, future financial statements. Okay, what you think could materialize in the future. Right, so how can we include budgeting in forecasting company performance? Yeah, how can we include it, budgeting, in the forecasting of the performance? So the performance is what? The day-to-day, right? Okay, so how can we include budgeting in forecasting company performance?
I'm also listening to this.
Okay, sorry, maybe it's not so clear then. All right, so if I'm looking at budgeting, we know budgeting, the focus is what? Planning. Okay? And if we're forecasting company performance, that relates to the future. Okay? Company performance is based on what? Correct, yeah. The day-to-day actions. Okay, the actions, the behavior, right? Okay, so if we're including budget in forecasting company performance, do you agree you could maybe incorporate an incentive? Incentive. Okay, so if we're looking at a budget, a budget could be, so for example, if companies don't meet the budget, what happens? That's bad. Okay, you could maybe say, well, we'll reward certain departments for meeting or exceeding the budget. Okay, and that would generally be more your sales. Okay, so if I'm looking at company performance, right, you're not going to know how much to, so what is the incentive? The incentive will be based on the budget. Okay, you want to exceed a certain expectation. Okay, so if your budget is providing for, let's say, let's say a 30% return. Okay, if your budget is providing for a 30% return based on the current targets, okay, what could you do? You could include an incentive, okay, as part of the budget to increase performance. So if we had to, let's say, exceed the budget. So let's say you forecast for sales and sales was 1, okay, but sales actually came out as 2, right? That's 100% increase in terms of what you budgeted for. Okay, there could be an incentive that you could maybe include as part of the budget to try help forecast or, let's say, improve future performance, okay, in terms of the company. The company obviously needs to perform. Companies need to generate value, all right, or profit. Okay, so broader assumptions, things that are affecting the company, let's say the whole company, or more limited in terms of departments. Okay, so you could have maybe one department. One department could have certain assumptions placed in it, okay, because maybe that department isn't going to be affected as badly by inflation. Okay, maybe another department will be badly affected by inflation. Okay, so you could use broad assumptions that affect the entire company or more specific ones. Okay, you obviously can build more complex models. That's like a Excel spreadsheet with different variables, and you would update variables depending. Obviously, internal and external factors, something to consider. And then they do talk about something interesting, which is the judgmental approach. Okay, what is the judgmental approach? That's looking at your, let's say, experience or expertise in a specific area. Okay, so when a company wants to budget, what do? They go to the different departments and they ask the departments, how much are you going to require in terms of budget? Okay, you can't have someone outside or, let's say, not involved in the process to budget for that department, because that individual wouldn't have the necessary experience or expertise, okay, to give judgment, okay, or to judge what sort of expenses and capital they'll need. Okay, and there you're looking at maybe bias in a way, okay, because if you're looking at someone's judgment, okay, that could be biased, because obviously a department will want as much of the budget as they can get, okay, and that could create a problem. Right. Okay, guys, that's the first bit. That wraps up support material 2. Okay, I did say I wanted to look at the assignment just to have a look if there was a budgeting question here. You had a discount here. Okay, there's a nice budget question. Okay. A firm has actual sales in November of 1,000 and projected sales in December, okay, and January of 3,000 and 4,000 respectively. The firm makes 15% of sales for cash, collects 45% of the sales 1 month following the month of sale, and collects the balance 2 months following the month of the sale. Okay, so do you see the type of question you could get? Okay, this is a short question. It's not a long question. You do see longer questions, okay, in terms of written. Okay, your exam is obviously half written, half multiple choice. Right, so if I'm looking at question 2, here's a perfect example of a budgeting type of question. Right, so if I'm just showing you guys how to do a budget type question, right, always draw a timeline. Okay, we just spoke about a budget. It relates to the future. Okay, so in order to budget, you're going to need some columns. Okay. Yeah, this is assignment 2.
Semester 1.
Semester O. Sorry, no wonder. You guys are looking a bit confused. Okay, sorry, that was on the wrong page. This is the right one, yes. Okay, semester 2, assignment 1. Okay. Probably, yeah. There was one in that assignment, but not this one looks like it. Oh, there is it. No, this is something else. No, don't worry about that yet. We haven't covered that. Okay, so yeah, unfortunately there isn't one in this assignment. Okay, so I'm going to just use that one as an example. Okay, we might as well. We started discussing it. Let's complete the discussion. Okay, assignment 2. Right, so this was assignment 2. This is on page 15. Okay, just to show an example of working out a budget. A firm has actual sales in November. Okay, so I'm starting with November. Do you agree? That's the actual. That's not the budget. Okay. December and January, 3,000 and 4,000. All right, so 1,000 here. Then you've got December and Jan. Okay, 3 there and 4 here, respectively. Right, 4,000. 1,000 here, 3,000 there, 4,000 there. Okay, then they tell you the firm makes 15% of sales for cash. All right, so now this was the total. Okay, the total needs to be split between, let's say split into credit, cash, and credit. Alright, so now we're trying to show the actual budget in terms of what we believe is cash and what we believe is credit. Okay, remember the budget is focusing on cash, movements in cash flow. Right, so 15% is for cash. So if I take those amounts and I multiply that by 15%, okay, that's going to give me the actual amount that I'm receiving in the form of cash. Okay, is that important? Yes, because this is part of the actual budget. Okay, NB, this is cash flow. Right, I don't care about the debtors. That's not important. You're only looking at the cash, okay, inflows and outflows, right, because businesses need to manage that. Right, 45% of its sales 1 month, 45% of sales 1 month following, okay, so the firm makes 15% sales for cash and it collects 45% of the sales 1 month following the month of the sale. Right, so now I need to look at November, December, and January. Okay, and what am I focusing on here? I'm focusing on the credit. Okay, that's what I'm looking at. Right, so you know with credit there's a lag, there's a delay. Right, so in terms of sale, right, or sales, okay, how much sales did I have in November? No. Yes, because we're looking at the receipts, yeah. Okay, we've already looked at the cash. We can't look at the cash again. We need to look at the credit. So how much sales did I have in November? Correct. Okay, it's the difference. Okay, and December also the difference. This minus that. And January, same thing. This minus that. Okay, so those are your credit sales. Okay, let's put a big heading there so we've got it. Okay, those are your credit sales. Okay, credit sales mean what? Accrual. Okay, accruals aren't cash flow. Okay, so I need to now discuss in terms of my working, when do I actually receive all of this? Well, the only way I can do that is by looking at the question. The question said 45% 1 month following the month of the sale, and the balance 2 months following the month of the sale. Okay, so if I'm looking at November's credit sales, how much do I collect in December? 45%, exactly. Okay, it's just the interpretation of the assumptions, okay, or the forecast, okay. And how much of November do I collect in January? No, the rest. So you collect 45% of the sales following the month of sales, so the balance would be how much? 55%. 55%. Collects 45% following the month of the sale, and the balance 2 months after. Okay. Because 15% of cash, 15% of sales is cash. Okay. And then now we're looking at the credit. Okay, so the 15% is cash. So there's the 15%. That's cash, right? There's the 15%. The other 85% is credit. Okay, so the credit, if you want to look at that, is the other 85%, right? Okay, because the cash was the 15%, right? Okay, now we look at the collection. So the collection is different. That's unrelated to cash. Okay, so 45 I collect here. How much do I collect there?
The remaining.
Yes, which is 55. Yeah, 55. Alright, so if I add those two, I'm going to get 850. Do I? Yes, I do. Yeah, 850. Okay, so that must add up to 850. Right, that's the forecast. Okay, December. How much of December do I collect in December? Nothing. How much do I collect in January? 45%. Okay, so that's what I would do. I would then have November's forecast, December's forecast. Would I collect anything in terms of January? No. January, I don't collect any of those credit sales. I collect credit sales in February and March. Okay, so that's all you had to do was just work out those amounts. Right, so what did the question ask for? They wanted to know what is the firm's expected cash receipts in Jan. Okay, so here's January. Okay, what are the receipts in January? There's an inflow and there's an inflow. Right, so all I'm going to be looking at is that. So total for Jan, well, let's do it this way, total for all of them. Okay, I would then just add up that bit. Okay, so 2215 is what you would receive. 2215. Not an answer. That's very strange. Okay, so let's try reinterpret the question then. Okay, yeah, there's a problem with this. This is possible errata here, unless I'm interpreting it incorrectly. Okay, so let's interpret it the other way. Okay, so let's interpret it this way. Okay, so I'm going to show this. Okay, let's do it this way. Let's just see if we get one of those options. Okay. Alright, so credit sales. Alright, if I'm looking at credit sales, we still have January, we still have November, December, and January. Okay, so I think maybe this is the way you were interpreting it. Right, in terms of, alright, so I have 15%. 15% is cash, 45% is credit in the month following, and then the difference, which would have been 40%, okay, is in the month following the sale. Okay, so this is the other interpretation. I don't know how they're expecting us to interpret this. I'm just trying something different. Okay, this, based on how I've interpreted it, that should be the correct answer. It's not there, which is a problem. Okay, so let's just see if I use this, other interpretation. Okay, I don't know why we would interpret it this way, but I'm just trying something different. Okay, 15% of sales for cash. Okay, so of the 100% total, okay, 15% is cash in the current month. Okay, I'm just trying to understand what this person did when they said the question. Okay, and then they said 45%. So of the 100%. Okay, 45% is collected, okay, yeah, after 30 days. We'll just use that, okay, a month later, right. And then the final amount, which is what we're trying to find, which would have been the 40%. 40% is collected 60 days, okay, after. Right, so I'm just trying something else to see if I can get one of those figures. If I can't, then I know there's a problem with the question. The 2215 is definitely correct. Okay, so let's see how would that change. Well, there's the total. Okay, so that total there, if I split that in cash, that doesn't change it. So I'm still going to have 15% for each of those. That's not going to change. Okay, so I've still got that. That's still inflow. Okay, what will change is this. So 100% of the total, 45 is collected after 30 days. So November, I would collect November's 45% in December. Does that make sense? So this times 45%. Okay, and I would collect 40% of this in December. Okay, I'm just trying something different to see if that works. Okay, I can email this to you, so you don't have to stress. Just try and understand what I'm doing. Okay. Well, yeah, that'll give you November's total. Yeah, because if you add up those three, this plus that gives you the 1,000. Okay, so now I'm going to do December. So December, that amount, I'm going to receive a portion in January. I would have received how much? 45%. Okay, which is that. Okay, January you would have seen nothing, you would have received something there. So is 2350 there? Yes, it is there. Okay, that's a very strange way of interpreting it. Is that how you saw it?
Yeah.
Okay, well, I saw it as the sales, well, 15% is sales, so the other credit must, the credit sales must be collected later. Okay. Alright, well, that's fine. Then you didn't make a mistake. Okay, I've had to do 2 calculations. You would have had to have done 1. Okay, but you still get to the same answer. Yeah. Alright. Okay, but yeah, so this was the interpretation that they wanted you to use. Okay, to make use of. Saying you've got 100% and you're just splitting it. 1, 2, 3. Okay, yeah, it's different. Again, it's just assumptions. It's interpretation. Okay, so first interpretation didn't work. Second interpretation did work. How did I interpret this one? So in this one, this was 100% of the sales, okay, was 15% cash, which is what they said, and then the other 85%, so 85% credit.
And then you split the credits 85, 45%.
And then they told you. So then info was given on the collections. Okay, and then the collections was credit sale, okay, 45% in the following month, right, and then the rest in the second month, which is what they said. So that was the interpretation. Okay, so a bit problematic in terms of interpretation. Okay, that's what I interpreted. I took 45% of the credit because 85% is credit and the credit must be collected. Okay, so how are you collecting your credit? That's what I'm looking at. Okay, so 45% of the credit sales, okay, is collected in the following month, and the rest, which would have been the 55%. Okay, the rest is the 55%. But 55% of what? Of these amounts. Okay, because that's the credit sale. It isn't wrong, it's right. The budget's still the same. So have a look. If I sum up all of these, so if I sum up those three, okay, and I sum up those three, yes. No, it isn't. Why is, oh, okay, it is different because the collections are different, yeah. Okay, but these amounts are the same. So the cash is the same, the sales is the same. Yeah, so the sales is the same. Right, the collections are slightly different depending on your interpretation. How do you collect?
In the exam situation, how can they wrong that wrong? If they're not going to
well, interpretation. They need to be more clear. That's the only thing. Just be more clear. So they should have said here, the firm makes 15% of sales. What sales? There should have been the word total there.
Sales.
Total sales. Okay? And then they should have said collects 45% of its sales. What sales? Be specific.
So total sales.
Total sales or credit sales? If they said total sales or credit sales, then I know which method they want.
So if we get into an exam and they say 45% on credit sales, we need to go with 85%.
Yes, if they said credit sales, then you would have used that. If they said total sales, then you would have used that. Yes, exactly. Okay, correct. Is that alright, guys? Okay, good question. So you've got the answer there from last semester. Right, that's obviously option 4. Okay, that's the only option I can get based on the 2 different interpretations. Okay, the keyword was either credit sales or total sales. They just said sales. That's the problem. Okay. Alright, guys. Let's quickly have a look at... was this theory, I think, or was this... Okay, the recap I'm not going to go through. Yeah, this was the theory chapter. Okay, there weren't any calculations here, were there? Yeah, there was a simple calculation. Right? And this is theory. Okay, so there aren't any hectic calculations here in study unit 3, so I'm just going to run through the theory this week. Okay, so at least we stay on track. Right, we do need to spend 1 week doing the assignment, which is only in September. Okay, but we need quite a bit of the theory to do the assignment. Okay, the assignment covers a lot of the chapters, okay, because the assignment is so late as well. Okay, September. Alright, so last bit for today, a few slides in theory. Let's look at it. Okay, support material 3. Okay, I'm not going to recap this. We just spoke about it in terms of depreciation. We spoke about cash flows. Okay, maybe something to remember is this. Right, so NB. Okay, remember there are equations that you need to do certain calculations. Right, we looked at that last week. Right, you need to know how to calculate OCF. Right, you've actually calculated OCF in FIN3702. Okay, but you did a massive calculation for OCF. Right, the same thing applies here. Remember, think back to that table. You drew a table. Right at the bottom, you had net profit after tax, and then you just added the depreciation. Okay, so you guys actually have the more advanced way of working out OCF. This, obviously, it's a smaller chapter looking at short term. That's the simpler way of working it out. Okay, because this would have come from where? The statements. Okay, you would have just picked that figure off the statement of comprehensive income. Alright, recapping the budget, we just went through it, so that's fine. There's the new section. Okay, it's all theory. Okay, the only thing difficult here is, do you know how to interpret what a current asset is, and do you know how to interpret what a current liability is? Okay, you get two things, liabilities and assets. Okay, so here we're looking at the difference between the two. Right, so what do companies need to operate efficiently? We just spoke about it. What is it? Correct. Assets. Okay, what assets though? Non-current is for what? Capacity. Okay, so we spoke about property, plant, and equipment in a previous module. Okay, capacity is your PPE. Okay, so the more PPE you have, the more capacity you have, i.e., you can manufacture more products, you can do more things. Right, and what else do they need to operate efficiently? They need cash. Okay, so assets are long-term and short-term. Okay, the short-term is focusing on this, the cash flow. Right, so companies need two things. They need capacity to operate, and they need cash flow to keep operating. What is liquidity? It's the ability to pay who? The creditors. Okay, how liquid are you? Ability or extent to which, or extent to pay, or to meet obligations. Extent to meet obligations. That's probably better. Meet obligations. Okay, that's what you're looking at. Okay, so how comfortable are you in terms of meeting obligation? Do you need to sell all these fancy assets to pay off simple current liabilities? Okay, so in financial planning, should managers monitor cash flow? Of course they have to, yes. Okay, why? It's because they need to manage day-to-day requirements in terms of operations. Okay, so the only reason why cash flow is important is because of operating, and that's why it's so key. Unprofitable companies can continue to operate so long as they manage their cash flow. Okay. Alright, the next bit, net working capital. There's the formula. That's the only formula that you need, which you probably already know from prior modules. Okay, take your current assets minus your current liability. That gives you your net working capital. Right, give me some examples though of current assets. Debtors, inventory, cash and cash equivalents. Okay, short-term investments. Good. Okay. Current liabilities. Creditors, that's the big one. What else? Short-term borrowing, overdraft. Okay, loans. Right, those would be the main ones. Good. Yes, okay, you could have a short-term portion of the long-term. Yeah, you could separate the two. Good, yeah. All right, so the most important thing there is that, are obligations being met? What is that? That's liquidity. Income received in advance would be a current liability. Okay, income received in advance, because you're going to have to either refund or provide the product or service here. Okay, so your income received advance would be an accrual that'll be part of your current liabilities. Yeah, we talk about these in a bit more detail later on when they cover the current liabilities section. Okay, so you'll see later on there'll be a section with current liabilities, and we'll talk about things like that, accruals, okay, that can affect the business. All right, so what conclusions can you make if the current assets are bigger than the liabilities? Good. Okay, so net working capital is positive. Is this company liquid? Yes. Okay, there is liquidity. Okay. What conclusions can we make if it's the opposite? Current liabilities greater than current assets. The opposite, yes. Okay, net working capital would be negative. Right, so liquidity, no. Okay, there's no liquidity in this business because they're going to struggle to meet short-term obligations. Okay, so i.e. operations, okay, ops will be affected. Okay, you could obviously discuss a few other things as well. Too much debt perhaps. Okay, too much leverage. There's a nice word that you've learned from other modules. Okay, leverage is a bit higher than the first scenario. Okay, and then what are the 4 important financial statements? There's 4. We spoke about 3 of them today.
Cash flow, financial position.
SOCI, 100%. Okay, good. So which statement tells us the structure of the firm's investments? Okay, and? Yes. No, not comprehensive income. Yeah, cash flow. Right, because cash flow would talk about structure there in terms of your financing. So you would be able to see it there as well. Okay, but that's the cash flow, cash only. Okay, so the key one is definitely that. So you're right. Okay, statement of financial position, the debt and the equity, that's key. Okay, and in terms of the structure, right, you could look at more information in terms of the financing. Right, how much interest is being paid, how much dividends are being paid. Okay, that statement would provide the information about the structure. Okay, good. Right, statement of financial position, we obviously spoke about that. And then the last bit, short-term financial management, what does that involve? It involves less than 12 months. Okay, so the firm's capital structure can vary. Okay, so when we look at things like how do I raise capital, do I use an aggressive or conservative strategy? Okay, we'll see what that means later. Okay, but what is that? That's short term. That's how I'm financing my current liabilities. Okay, so how am I going to pay my creditors? Right, do I want the cash sitting in the bank, so whenever they want the payment, it's sitting there in the bank? Or if they want the payment, do I then need to source a loan to pay them? Okay, it depends on you as the business. Okay, so short-term management is key. What am I trying to do? I'm trying to look at the level of investment needed. Investment is the level of resources required to meet your short-term commitments. Okay, so firms must manage all of those, inventory, debtors, cash, etc. Why? It's going to determine whether the company is going to be profitable and whether there's more in terms of high or low risk. Okay, which type of scenario would have higher risk? A company with little or lots of current assets. Okay, there will be higher risk with a company that has fewer current assets. Okay, because now there's not only risk in terms of operations, but also risk in terms of liquidity. It's a liquidity risk. Okay, a liquidity risk exists because you don't have sufficient short-term capital. Okay, and then I've showed you this. Okay, this is going to be expanded on in a later chapter. Okay, you're going to look at things like EOQ. You're going to look at things like cash conversion cycle, operating cycle, average collection period, average payment period, those types of things. Okay, so you'll see this diagram again later, and we'll talk about this when we look at converting cash into different things, okay, and then bringing it back into cash. Okay, that's the business, right? A cycle exists as cash changes form and reverts back to cash, right? It's just something that it's a medium of exchange. Okay, the economists talk about cash as a medium of exchange. That's exactly what it is. Okay, you can convert cash into different things. It can become inventory, it can become debtors, it can become all sorts of things, but companies need it back in cash because cash is how you actually manage and run the business. Okay, so working capital is current assets and what's in circulation. Okay, and then we'll look at each of these sections in different categories at a later stage. Okay, guys? I've given you an example here. I want you to think about it for next week. Okay, I'm going to recap this as a start for next week's discussion because it's leading on to some of those workings. Okay, so if you can, just try to draw a diagram. Okay, it doesn't have to be very complicated, but try to do as much as you can to include something about cash transformation. Okay, so how can we transform and change it? This was the simple diagram. I want you to try maybe add or at least bring in a few different factors under each of these that would discuss, okay, the cash transformation. Okay, so what are the different stages, right, when running a particular business? Okay. All right, guys. Don't worry about this. We'll talk about this next week after we've discussed that chapter. Okay. All right, guys. That's it for today. Thanks for attending today's class.